Between the threat of US tapering, India's wedding season, and volatile markets, gold continues to baffle traders. Hoping to provide a clearer picture for you, I'm joined on the phone now by Carsten Fritsch, Senior Commodities Analyst at Commerzbank. Carsten, many thanks for joining me. Now to start, the World Gold Council has today released the information that demand for physical gold jumped 53% in the second quarter. Where is this demand coming from?
If you look at the numbers, you see that jewel demand, for example, was up 37% year on year and rose to the highest level in almost 6 years. Demand for bars and coins was even up 78% year on year and reached the highest level ever for one quarter. And if you look at the country background, demand in India increased by 71% year on year, and in China even by 85% year on year in terms of total demand. So demand is mainly coming from buying of jewelry, bars and coins in China and India.
Yet despite this, the World Gold Council have also indicated that demand for the precious metal is in fact at a 4-year low. This creates quite the diverse picture for gold. Can you expand on the drivers behind this data?
Apart from the very strong demand, physical demand for bars and coins, which I already mentioned, there was one major drag on demand in the second quarter. This was the massive selling of gold ETFs. ETF selling amounted to more than 400 tons in the last quarter, according to World Gold Council. And that was the main reason why total gold demand was down 12% year on year and fell to the lowest level in 4 years.
Touching on Chinese investment just for a moment, and traditionally gold investors from this region have bought gold when the price is rising. What does this level of demand, for example bar and coin demand in China is currently at an all-time high, within a falling price environment suggest?
I think that suggests that the demand for gold, the hunger for gold is still very strong in countries like China, given a rising middle class, rising incomes, long-term inflation risks. This is quite reasonable. And China is very likely to overtake India this year as the largest gold buyer due to the strength of demand in China and somewhat weaker demand in India in the second half of this year. But overall, the picture remains that gold is moving from rather weak hands in the west to the strong hands in the east.
We've also learned today that hedge funds are cutting gold holdings, with several organizations more than halving their ETFs. Talk us through this thinking and what price action you think we can expect as a result.
Yes, according to the yesterday's SEC filings, hedge funds and investment companies sold roughly 4 million ounces of gold from SBI Gold Trust, which is roughly 50% of the total outflows from SBI Gold Trust in the second quarter. And this is also a confirmation that this weak hands or investors who bought gold to participate in short-term price movements are currently leaving the market, and we think that the majority of these investors already sold, so the headwind from this selling should abate in the upcoming months.
Carsten, many thanks for your comments. We may be nearing the end of the trading week, but don't go away as we've still got plenty more exclusive interviews for you. Goodbye for now.